Hi, I'm Nolan Baker with America's Retirement Headquarters. Today I'm going to talk to you a little bit about our unique approach called the independent income system. And what we're going to do is we're going to walk you through some of the threats and opportunities that are facing many retirees today. If we take a look, this is the process that we put together to build out the independent income system. What we do is we focus on how to help people better manage their money, protect their hard-earned assets, and efficiently plan their estate. So when you think about retirement time, you need to have a little bit of a mind shift. Retirement is quite a bit different than when it is when you're saving and accumulating assets to grow for retirement time. And the reason being is the sequence of returns and other events can dramatically impact a retiree as they begin to take withdrawals out. So being able to put your portfolio in a position to try to take advantage of all the opportunities and avoid some of the threats or blind spots that could be out there could be extremely beneficial to how you position your portfolio to go forward. So let's take a look at it. What we do is we break up the independent income system into a couple of different buckets of money. The first bucket of money is current income. And what I've done on the graph here is I've highlighted in red some of the potential threats that maybe you want to take a look at in your situation to try to avoid, as well as the green are maybe some opportunities that you want to become aware of in today's environment. So when we're looking at current income, I think one of the risks that I would see many investors making is that money is still exposed to stock market. So if you have your money in the stock market, the challenge is nobody controls what the stock market does on a short-term basis, and you run the risk of sequence of returns risk, meaning that if the stock market goes down, what happens is in taking withdrawals in the declining stock market, you're forced to sell off more and more of your investments to get your monthly income. It accelerates the potential loss in your portfolio. The other thing that I see many investors do is what is called a pro rata withdrawal. And what a pro rata withdrawal is taking money out of the account by selling off a little bit of each holding that you have in the account. So again, not taking into consideration how each investment is performing to determine where you want to come up with the income. A great opportunity to take a look at it right now is in that bucket of money. I would encourage retirees to have somewhere between 1 to 5 years worth of money in an account that's conservative and or maybe not even in an account that has the ability to have losses. Then you can confidently be able to draw income out of that account for the next 1 to 5 years. The next area that we take a look at is what I would call reliable income. So when we think about reliable income, we're normally thinking about Social Security, pensions, or annuity income. When you look at reliable income, one of the important things to do is to have a written retirement income plan. Now, I'm not talking about a financial plan. A lot of people have financial plans and they can be very beneficial too. But a written retirement income plan is taking a look at what your sources of income are, trying to identify the ways that you can control how to increase your income. As an example, right now, roughly about 70% of retirees elect to take Social Security before their full retirement age. By doing so, what that does is that forces the retiree to have a lifetime penalty for electing benefits early and can have a negative impact on survivor benefits. I oftentimes hear, well, Social Security is going broke, or I've run the break-even analysis and I've got to live till maybe age 75 before I even get my money back. When we're looking at reliable income, what I'm betting on is I'm betting on you living a long time. So it's not about breaking even, it's about making sure you have enough reliable income for you and your spouse for your entire lifetime. Again, some of the areas that I would see are additional risk is not protecting what is called essential income. Essential income is what you need to cover all of your basics in life, your food, your housing, your clothing. That type of essential income needs to be protected, in my opinion, between pensions and Social Securities. And if you have a gap, an annuity could be an option to be able to fill some of that gap to provide additional income. Then The other area that I would say for reliable income, meaning money in 5 years or so down the road, a risk right now facing many retirees would be increasing interest rates. So as interest rates go up, historically speaking, what bonds have done is gone down. So if you look at a lot of the capital market assumptions with the potential returns of rising interest rates and bond funds, it has a low to sometimes negative outlook on what the expected returns could be. In your portfolio, that's where you want to be conscious about those type of investments that you own. That could be bond funds. If you have a variable annuity, it could be the sub-accounts that you own. A couple of opportunities over here in the reliable income category is you could eliminate interest rate risk if you went and you purchased individual bonds. So if you own an individual bond and you hold that bond to maturity, what you do is you eliminate the interest rate risk. Another alternative where you have the potential to have gains if and when the market goes up, but also to be protected against loss if and when the market goes down, is what is called a fixed index annuity. Sometimes we'll use that as the alternative in the reliable income category. Now, this area with the pay raise in today's environment is an area that maybe you haven't looked at in a little while, but it's a good area to revisit. Inflation for a long time hasn't been a big issue, except recently we've seen the impact of inflation. And I guess if you take it a step further, for retirees, inflation probably has been an issue for a while when you factor the cost of healthcare. Healthcare continues to go up for retirees, but in today's environment, not only do we have increases in healthcare, we have increases in transportation costs, what it costs to buy a new vehicle, how much it costs to fill up a car, cost increases in groceries, and really cost increase across the board. So one of the things that you want to do is you want to stress test your portfolio to determine what the impact inflation could have in the long-term success of your overall plan. One of the things that we do at America's Retirement Headquarters is we have the tools and resources to be able to stress test your plan to show you the probability of success if inflation continues to be high and how it could erode your purchasing power over time. The good news is there are things that you can do about it. So what you can do is you can put in different income riders on certain accounts. Another thing, if you haven't taken a look at, would be investing in U.S. government bonds. Again, an area to explore. I-bonds are inflation-protected type securities. And if you look at what the U.S. Treasury rate at the government, the rates have gone up quite a bit, just like what we've seen. So maybe an opportunity to revisit something that you haven't looked at in decades, but in today's environment, could be a really good opportunity for you. The last category is long-term growth. We here at our firm, we love having money positioned for long-term growth. And usually in long-term growth, what we're talking about is owning equities or mutual funds or ETFs or things that allow us to participate in the long-term growth of the U.S. economy. An area that I think a lot of people maybe haven't thought about is using circuit breaker technologies. So the traditional approach of buy and hold works well as long as the overall market continues to go up. I also see a lot of investors, they would take what I would refer to as a buckshot approach when it comes to investing their money, meaning they or their investment firm has decided to put a little bit of money on each and every category in hopes that more goes up than down on any given year. Now, I served in the United States Marine Corps, and so in the Marine Corps, we either hit our target or we missed. So I would tell you with your long-term growth to take a sniper shot approach when it comes to investing. By taking a sniper shot approach, what that means is that you really need to know what you own. So I ask you, if you look at your portfolio today, you've probably got a whole bunch of different investments. But do you know what those investments are and what is owned in that portfolio? Because not knowing what you own can be a major risk right now. At our firm, what we do is we like to invest in companies that are investments that people use every day, daily essential type companies. We also like to look at companies that have strong financial balance sheets. So maybe they have a lot of cash in the bank or low debt. Just like any other household, the household who has cash in the bank, good savings, and reliable income, if something bad happens, that family is much better off and much more likely to be able to weather through a downturn in the market than somebody who lives paycheck to paycheck. So think about your investments in the market the same way. The other risk is, again, not having some type of circuit breaker in place. If and when another major market downturn happens, what is the current plan that's built into your portfolio that would be designed to try to protect you to help try and limit losses if and when the stock market went down? So again, as you're younger, the decline in the market doesn't matter as much. So somebody putting money into their 401k maybe in their 30s or 40s, if the stock market goes down, it doesn't feel good, but that investor is able to purchase more and more shares each and every month. So as the market recovers, the long-term saver, a declining market, again, isn't a big impact. When you're at retirement time, you're no longer getting up and going to work. So your money has to get up and go to work for you every single day. So if a declining market happens and you're not putting money in, it's a real big impact on a retiree. So that's where in long-term growth, we can take a look at some unique strategies to incorporate circuit breakers and really help you understand what you own overall in your portfolio. The last category that we take a look at here is having an emergency account. Let's look at it. Life throws you what ifs. We just don't know when that what if is going to happen. That emergency account, it could be anywhere from like 6 months worth of income. Maybe you feel comfortable keeping $25,000 available for different emergencies, which in most cases will cover about 80% of emergencies that come up. Or also in this scenario, this is an area where you could leverage your assets to be able to get you more benefits in these other two categories. So again, with the philosophy of the independent income system, we're looking at 3 areas: how to better manage your money, protect your hard-earned assets, and efficiently plan your estate. Once you have your investment portfolio put together and you really understand how each account is designed to work, the next question that we look at is now what's going to blow it up? And one of the things that can blow it up for a senior or retiree is an unexpected and unplanned for healthcare crisis. That's why it's important that we put this asset protection shield over top of your portfolio. At our firm, we also work with America's Medicare Associates. With America's Medicare Associates, we can give you guidance regarding enrolling in Medicare, understanding the different options and what your other plan choices are to help fill the gap. If you retire before the age 65, America's Medicare Associates also can help you with determining what might be the best health care plan for you, either Affordable Care Act, COBRA, company insurance, maybe if you served in the military, what those benefits look like. We can give you some guidance and advice with our team, again, through America's Medicare Associates. And then ultimately dealing with the issue of long-term medical care. It's never fun to think about what if somebody ends up in a nursing home, but it's no surprise that at the cost today, it doesn't take very long before the average American family is financially wiped out if a loved one goes into a long-term care. The good news is there's choices and there's options available. So buying traditional long-term care insurance is a solution, but there are many other solutions out there that allow you to leverage your assets. Some cases, people served in the military. You could be entitled to benefits from service to the military. You could look at a life leverage plan. So we can show you different options to be able to help leverage your accounts to, again, put a shield over top of your assets from an asset protection plan. The final category that we work at down here is the legacy plan. When you're looking at the legacy plan, it's not only important to have the right legal documents in place, and it's a good idea to make sure that you have a conversation and sit down and talk with an estate planning attorney about things like wills versus trust. But the same would be true when you're looking at your financial assets. You need to have the properly named beneficiary plan in place, and revisit what your beneficiaries are. So if you haven't taken a look at your beneficiary forms in the last 2 years, or if maybe you've had some type of life change that has occurred, it's a really good idea to look at the beneficiary forms on all of your financial accounts. The other area that we look at from a legacy plan is taking a look at how the surviving spouse's income would be impacted if and when there happened to be a premature death or somebody passed away. So what would be the impact of maybe a loss of Social Security income? What would be the impact of maybe a loss of the pension or part of the pension? These are all type of things that we take a look at when we're finishing up the independent income system and looking at the legacy plan. So hopefully you've got a couple of good tips today that you can take a look at your individual situation, maybe be able to identify some of the threats that we're talking about today, try to address those threats, get them checked off the list, as well as identify where there's some opportunities in today's marketplace. Look, I'd love to give you a second opinion. I'd love to sit down and have a conversation with you about your finances and determine if the independent income system could be the approach that you could take to help you not only survive but thrive in today's environment. I'm Nolan Baker with America's Retirement Headquarters, and I look forward to talking to you soon.